record on this computer. Let's do it. Awesome. Awesome, guys. So let's so last week we did end, we were all looking at this GBP JPY, looking at this current. Actually, let me know if you guys can hear me. I'll keep talking, but I'll just see what you guys say. So last week we were looking at this GBP JPY, and we are still looking for this move continuation to the downside. At least I am. I'm going to be a little bit more cautious with this JPY because I feel like we're getting a little bit of risk on, but we're not getting risk off. Awesome, Anthony, sweet. So we're not getting as much as I kind of would like, but I think after we ended up on Friday, or how we ended on Friday with the Chinese investment, so we'll take a quick look at that. What was that? So we'll go to Wall Street Journal, and let's see. There's China, U.S. and China investment. So U.S. polling investment from China would be an unmitigated disaster. So again, what we're looking at here, this is kind of just someone's opinion. So I don't really care about what Stefan or Steven is saying. I just want to know what the facts are. I want to know what actually happened. We can actually find out what happened. Someone's got to mute their mic quick. Sweet. Okay. So we need to understand the factual part of this. So we have Trump's plan to restrict U.S.-China investment. So we need to actually see what are the details of Trump's plan with restricting the U.S.-China investment. So it sounds like Trump is wanting to keep more capital here in the U.S. instead of, having flows flow to foreign economies. Investing in China. It sounds like Trump wants to keep that capital here. Now, China, again, it's the same thing we're kind of looking at. Instead of tariffs, we're almost looking at what is China going to say. And it looks like we might have seen some, I wouldn't say retaliation, but it looked like China said they were planning on keeping the doors open to, let's see what it was. So China, we can find it. Sometimes it takes a little bit just to kind of, China investment slides to, let's see if we can find it. China investment. We'll try China keeping foreign investment open. Foreign. See if it shows up. Open. I was going to mute their mic again. Sweet. Okay. So we'll see if that is. It might be a little bit hard to find. I'll have to see. Maybe we might just come across it. But this to me could possibly be kind of maybe a little bit of an escalation. I wouldn't really say it's much. We're really going to have to kind of wait and see what China is going to actually say. But what I was kind of referring to just a second ago was that it sounds like China, they were kind of unfazed by this, and they were saying they were going to They were going to keep doors open for foreign investors and not block. Well, they're going to let China domestic investors invest overseas. So they weren't going to block Chinese investors. I think that's what I saw. So hopefully we come across that. So what I kind of wanted to see, and I wasn't really seeing much push through. Yeah, here it is. Okay, yes, awesome. This is it. Oh yeah, I did. Okay, it was on Bloomberg. Sweet, awesome. Thanks, Anthony. So yep, China vows to continue opening financial markets. This is what it was, exactly what I was looking for. So China said it would continue to open up its financial markets and encourage foreign investment. So when it's saying foreign investment, China is allowing foreign investors to invest in their economy. So that's kind of what they're meaning. So when we're seeing foreign investment, that's what they're referring to. It could be, people here in the U.S. or investors here in the U.S. investing in maybe some sort of ETF, government bonds in China, or maybe some index that China has. So that's kind of what foreign investment is. And also, I'm sure that entails or includes businesses in China as well. We will take further steps to promote high quality two-way financial opening, encourage financial institutions and funds to invest in the domestic financial market to boost competitiveness, and so on. This is exactly what I was referring to. I've got to mute their mic again. Let's see. Okay, cool. Okay, cool. So this is kind of what I was referring to, exactly what I was referring to. So I'm a little caught in between, are we going to get to this, are we going to see that more yen strength, which we could maybe say just stagnant on this yen, to get to this 131, because this is the level that we are looking at, that we've been looking at since up here. Now 131, we still have probably, this is going to be about 100 and, let's see how many more pips, maybe 100 and maybe 200 pips. Let's see what we're looking at. It lets me. So we're still looking at about another 150 pips to the downside that we would like to see for our target. Now this is our target at 131 that we've been looking at since up here. So we were to drop down to that 4 hour. Now guys, I mean, this is where your entry should have been at this 23.6. I don't want anyone to start kind of straying off and trying to take breakouts to the downside unless you already have some sort of exposure to this. If we start to get too far away and you guys are still trying to work on the 23.6, you're starting to deviate away from your actual edge. So the edge should have been up in here when we saw this consolidation and the fundamentals and the conditions were intact. Now we could have also got in, I did close out a little bit right in here, but I did re-enter again on this retest. So let's take a quick look. It's the same stuff, guys. This is the edge. This is the strategy that we're looking for. We get that. It comes back and it retests this base. Now, there's going to be little different nuances. There's going to be little different structures, and it's going to look a little bit different every time, but you're seeing the same pattern. Where consolidation, it breaks out, retests, and then we see continuation to the downside. Now, depending on how you drew this Fibonacci, again, this is a dynamic tool. The Fibonacci is not some secret that people like to make it seem. We're rationalizing it from a liquidity standpoint, and rationalizing that, okay, well, markets, they like to make retracements under the right circumstances, under the right conditions. Now, we did take a little bit of an early break. We are looking for this to, at least, I would like to get to the 50. This is that 131. We are still at this 38.2. Now, if you guys still have, some of you more experienced guys in here, like Anthony, if you guys are, and anyone else, Jason, if you guys are taking breakouts, or if you're trying to scale into the position, we all need to understand if that bias is still intact. Are we going to get that GBP weakness and that JPY strength, or are we going to get JPY consolidation and some heavy GBP weakness? Now, it doesn't have to be heavy GBP weakness, but we would need to see some sort of weakness in GBP, and also aligning us with the indexes, for it to see where we're at with structure. Now, when we are scaling in, guys, most of the time we want to at least add most of our positions in between the 23.6 and the 38.2. Now, there may be times where we can take breakouts maybe a little bit later, if we're at the 50, but we got to understand that the more we start retracing, and maybe the fundamentals aren't, I'm not gonna say all intact, but if things are still a little bit stagnant with the fundamentals, or you don't think it's gonna continue to push, we shouldn't be adding positions. Now, again, it's not always gonna work out perfectly, but to get most of your positions on between that 23.6 and at least that 38.2 in hopes that we're gonna get to this 50. Now, I don't necessarily hate a break of this 38.2 to come down to this 131, but we need to understand that we are at some structure. We do have this little retrace here. It comes back, it retests right here, and we see that move up. Now, if we do break this, we are going to come to 131. But I'm personally going to want to see, to put any more positions on, I'm going to want to see something with China and the U.S. I'm going to want to see how this index is aligning. So if we take a look at this GBP and this JPY, I want to see where we're at on the JPY. We'll check that out first. Now, let's look at the daily. How do we end up last week? So we did come back right here, kind of a weak leg, retraced all that, came in from these highs. So if we were to just ask ourselves, where are we at on that leg down? We are at the 38.2. We did kind of retrace off of that. I would like to see a little bit more upside on this JPY. We did break out of here. consolidation. We did break out. We're only at the 38.2. Again, I say this a lot. I don't think we're asking for much if we can at least get up to this 50%, this 50% level right here. I don't think we're asking for much. Let's just bring that down a little. So I think we could possibly get up into this 50%, but I'm going to want to see a little bit more of this JPY strength coming into the market. Now, if I think we're going to get a little bit JPY, I think I would like to see some heavy GBP weakness come into the market. So last week, we did have some Bank of England. Who was it? I think it was Harker. We'll take a look. No, that was US. Let's take a quick look. So that was, it might have been Wednesday. Let's take a look. Thursday, nope. Consumer confidence, not really looking at that. We'll see. Let's see. Maybe we'll just type it right here. We'll do bank. Actually, I think I was looking at on the Financial Times. So this came out on the 27th. So that was on Friday, if I recall. Yeah, Friday. So it says the pound is sliding again in the face of continued political deadlock. We know why, it's Brexit. And increasing evidence, the uncertainty is wreaking damage on the British economy. Despite a week of political theater and courts in the Commons, investors are still struggling to see a way through Brexit. Okay, that's kind of what that's what we've been looking for. We're still understanding that it's going to be hard. I still feel it's going to be hard for us to get a deal for the pound and for the UK to actually get a deal from EU when we still have Boris or Bojo's do or die approach still there. He is so determined and stuck on getting out on October 31st. So that's coming up fast. That is coming up. It's about a month, exactly about a month from now. It's coming up extremely fast. That he wants to be out by Thursday, the last Thursday of October. He wants to be out by then. And he has this do or die approach. And he's actually used that rhetoric. So he's very determined on that. Now it's just about understanding, what's he going to push Parliament? What's he going to push his party to do in order for them to get out on October 31st? Now so Friday's fresh fall in the pound came after a senior Bank of England official said the central bank could still lower interest rates even if the UK avoids a no-deal Brexit. So it could still lower interest rates even if the UK avoids a no-deal Brexit. This is pretty important right here. Now, again, guys, here's what we want to do. Here's how my mind's working. You guys have seen this before. I draw the circle up. I draw another circle. I draw the other circle. Or we should start with the left circle. Pressing catalyst Brexit moves into the economy, moves into the central bank. So under the central bank monetary policy falls this type of stuff, this rhetoric from the senior Bank of England official. Because he is reacting to the pressing catalyst. Relate it back to the pressing catalyst. That's what it is. So whenever we're looking at something like this, always remember the pressing catalyst so it's not so confusing. It's what has the pressing catalyst done? What is the pressing catalyst going to do? What is our bias on the pressing catalyst? What is our bias on the China trade war? What is our bias on Brexit? I can't stress that enough. What is the bias on the pressing catalyst? It all comes back to that pressing catalyst. So remember this, guys. He's talking about the pressing catalyst. He's reacting. If the pressing catalyst wasn't there, if the Brexit wasn't there, would he be saying this? No. Sorry, Spotify popped up. So Michael Saunders laid out the damage that Brexit uncertainty was doing to the British economy. So same thing. He said right there what Brexit is doing to the British economy. Pressing catalyst, what is it doing to the economy? He's saying it in different terms. We're looking at it from a different perspective. This is his job. This is our job too, but we're looking at it from outside. He's kind of seeing it from the inside, in my opinion. So that he's saying the same thing. So if we can go back and understand what's going on, what is he referencing? What is he talking about? Now, all these indicators that you guys have looked at inside the academy, unemployment, inflation, GDP, all that type of stuff is what he's mentioning. Now, let's take a look quick. GDP, let's open this. All we needed to do is a quick glance through. Now, as we get a little more advanced, as you guys get more used to it, we can look a little bit further into GDP and all that correlation, but I don't want to overwhelm anyone. Inflation rate, let's check that out. Let's look. Current account, I'm not really paying attention to. We can look at some manufacturing, but I want to look more at the labor. Do we look at unemployment? Okay, we'll look at, let's see, prices, money. Where's consumer? We'll look at retail sales. And we're going to take a look at, we'll just stick with these. Now, this is going to give us a decent insight to what's happening. Boom. This is the furthest, this is the biggest reading or the lowest reading that we've had. Let's take a look. This is why you're kind of referencing matters. We need to see when was the last time. It looks about almost 9 years. This is the last time that we've seen a negative reading. Well, I guess we saw it right here, but this is even more. This is the more negative reading than we've seen in the last 9 years. So again, guys, pressing catalyst, the same thing. I just want to stress that. I'm gonna jot it out for you guys again. Because I need, guys, at least, I'm just glad this webinar is recorded. This is a good one. So I am going to, same thing, guys. Eclipse, let's pull that out. Boom. Be a little bit efficient. We're going to pull that out. Oh, no. Hold on. What is going on? 1 second. There it is. Okay, cool. One more time. Boom, boom, boom. Guys, right here, pressing catalyst, economy, central bank. This is the middle economy. This falls inside of, if I could take this little link and put it inside of that circle, that's under the economy. If I could take this, if we're just, visual representations, if I could take this quote or this article or his rhetoric and put it under this one, that's what that is. Boom, the frog's jumping. Boom, boom, boom. Right there. That's it. This is the pattern. Boom, boom, boom. Pressing catalyst, economy, monetary policy. There's different subcategories within that. This is what he's referencing, guys. This is what, pulling back, Michael Saunders laid out the damage that Brexit uncertainty was doing to the British economy. What is he referencing, guys? We just took a look at that. Negative right here. GDP growth rate is turning negative. Right here. First contraction in nearly 7 years. So that is an impact because of the pressing catalyst. Now let's take a look at the GDP annual, a little bit different reading. You can still see it's negative. Kind of close out of that. Now we're going to look at the inflation rate. Guys, let's take this is the lowest reading we've seen since October, so about a year now. Let's take a farther look out and see what we're looking at. Okay, this is what I kind of like to do. Let's see. I like to kind of go like this. There's that little point we can see right here is that little tip. The last time we saw that, boom, was back in about mid 2016, beginning of, or end of 2016. So about 3 years that that was the last time we've seen a reading this low. So guys, because of the pressing catalyst. I'm not gonna say it's as simple as that, there's a lot more to it, and we're gonna go into that. You guys should know what that is. Now, unemployment is at some lows, that's not bad. That is not bad. So that's just one area. Now, when was the last time we saw that? That was September 10th, so about 2 weeks ago that we've seen, a little over 2 weeks that we've seen this reading. And we've kind of been ticking down. So that's not terrible, but retail sales, again, has been on the decline since about spring of 2019 of this year. Now, if we can look at a reference, not the best one, but we like to look at the yearly, kind of see where we're at. That we can see we've been making pretty strong sell side or just downside movements. Now, we kind of jump back to June, July, kind of see where we were getting. Consensus, we missed consensus. Boom, B consensus, B consensus, but down from the previous. Missed consensus, down from the previous. Now this is coming out in about 2 weeks or a little over 2 weeks that we'll see the next retail sales. Now guys, this is all going to be important that we need to understand, okay, well, what's going to come out for this reading? But we can be a little bit forward looking and anticipate that, I think this is going to continue because I don't think Brexit does it make sense right here? Again, it's all about logic, guys. Think about this from a business standpoint and a consumer standpoint. Do you guys think that consumers have been more confident with Brexit as of recently that we could see this come out to be some good number? In my opinion, I don't think so. Now, this definitely could come to the upside. There may be some other factors at play, some ancillary things or some behind the scenes, but that's kind of how I'm looking at this. If I'm, I'm imagining myself in the UK, I'm at some UK store, just anywhere, or just seeing Brexit from the UK perspective, from a consumer perspective, from being a citizen there, do I think this has actually gotten better? Not necessarily. I mean, there's some stuff that's gotten better, but would it makes, as a consumer as a whole, as a conglomerate, as everyone, do you think that we could get a better reading as of lately? And I just don't really think so from my logic. Now, we could, like I said, we could get a better reading, and that could be a surprise, but I don't think that's going to be really enough for the central bank to maybe hold off on rates. I think they're going to want to do more of an insurance kind of cut, with like the Federal Reserve did. So we have the Federal Reserve wanted to do more of a cautious cut. They wanted to just cut rates just to kind of mitigate or hedge against the trade war. So it wasn't too late. So they weren't too late to the ball game when things are already starting to tank. So that is my opinion on this Brexit. And I think we can maybe see a little bit more downside. Now, how much is actually priced in? Let me get rid of these quick. I think there is still some more. I'm gonna take a look at this on the weekly. So if we look at this on the weekly first. Now we are at some structure here on this index. Let's just kind of see in relation how much of it do we kind of retrace when we made about a 50%. Cool. Not going to look too much more into that. Again, I want to look at from structure and the fundamentals, put more emphasis on that. Now, we did kind of have this pretty decent run up. Now, I would like to see this thing continue its sell side at least to, I'm not going to, this week, there's no way, we're not going to get to these lows this week. I mean, unless something crazy happens. Now, do I think we can get to, let's take a look, somewhere in between here, somewhere quick, draw some structure, somewhere in here, definitely, I definitely think we could get up into there. Now, if something crazy comes out with Bojo, can we have some crazy sell side to these lows a little bit deeper? Definitely. But as of right now, I would like to see this thing come back down into this 1203, this 1200s. So that's kind of what I'm looking at, and that's why I'm looking at. So I know hopefully a few of you are actually on the same page. Now, let's take a look at this Australian dollar. And guys, shoot some questions over if you do have any. And we're going to look at this New Zealand quick. Because this New Zealand could be, let's take a look at what the central bank came out with their meeting. Let's see if we can find it here in Financial Times. Reserve, think of new. We'll kind of see what we get, because we're going to get something on the monetary policy. So 1 second as it loads. Let's see if we can find something. Okay, so we will get, where is it? Australian July, what happened? Let's see. Let's go back quick. There was just a quick article on that. New Zealand dollar, also, okay, cool. Let's do that. That was Wednesday or Thursday. Open link a new tab. Now let's take a look at just a brief consensus or whatever happened. So let's take a look at that. That's pretty important. Let's see. So New Zealand dollar strengthened on Thursday after the governor of the central bank, so that's Adrian Orr, downplayed the likelihood of restoring to non-conventional monetary policy to stimulate the flagging economy. Non-conventional monetary policy. What is he referencing? He's QE, rate cuts or anything like that, bond purchases, asset purchases. We'd have to look a little bit more into it, but it's kind of the same thing. In a speech, Reserve Bank RBNZ Adrian Orr said the rate setters were unlikely to need unconventional monetary policy tools, but we would be remiss not to prepare. So they are obviously, they are just saying this as of right now, at the current state of the trade talks, at the current state of the economy. Let me get this out of the way. I'm tired of seeing my name. At the current state of the economy, they do not seem or see that they need to be cutting rates at this point. Now, guys, if things do get substantially worse, or maybe even, no, it doesn't have to be substantially, but if things do continue to get worse, this could be a scenario where maybe there's going to be it might be a third rate cut for the New Zealand to be priced in. And are we actually, are we kind of starting to see that? Maybe. So let's take a look at how we did last week. And again, guys, I'm going to do the same thing. Let's just jump to there. I want to see how the New Zealand economy is doing. I want to see what it's actually looking like. So jump to there. So what looks like on the 20th. So the 20 right here, you can. So I think it was probably somewhere right in here. This might have been it, because it's would have came out the day. Also would have been the next morning, I think it was. So somewhere right in here that we did see this meeting come out. And again, we did kind of push up into structure. Now, am I totally buying that this is some turnaround in the market, that we're going to get NZD strength? Eventually, I want to see NZD strength, but I kind of want to see some stuff clear, or a lot of the stuff to be priced into the market. And I don't think the possibility for, let's take a look, third, let's see where we're at. I think it is a third rate cut. Let's see. It loads. So 1, 2. For a third rate cut, I don't see that it's fully priced into the market. Now, the slightest thing that we start to hear about the trade war possibly coming back, it's still there, but the slightest rhetoric maybe that Trump may not be meeting in October, or even the scenario that what Anthony sent over about China vows to continue opening financial markets. What if China changes their mind? What if they say, okay, well, we might exclude the U.S. in some retaliation, or maybe it could be possibly Xi doesn't want to meet with Trump because of this, or just really be open your mind to what could be the possibilities if China does maybe change its mind in the possibility of what Trump could be doing. So we can't be so surface with this and say, okay, well, this is happening. Boom. We need to, again, forward thinking. What is what could possibly happen now? We need to try at least be one. It's hard to be one step ahead of the market, but we need to do our best to at least be and anticipate. This is the game of chess. Trump moved his queen, Xi moved his king, and we're just these pawns kind of trying to fit in there and make the best decision that we can, or whatever. It might have been a terrible metaphor, but it's a kind of a game of chess, and we need to be, the moral of the story is that we need to be forward thinking and at least try to think ahead what could possibly happen. Now, it's still very odd, but it's not surprising that Trump, after seeing some optimism with his trade stuff, that he does decide to cut some investment off to China. So it's showing me that there still is a possibility for this to escalate. So what I want you guys to do is screenshot, go to your indexes, and let's screenshot this. I need every single one of you guys, all 15 of you, to go to your indexes on the NZD index and just screenshot this chart, or this move down, and right here, and at least price in what happened. You'll say, mark up that there was that rate, or that optimism about not needing current rate cuts right now. Copy and paste this, just the headline. You don't need the whole article. I'll send it to you guys, so you guys can start to see this play out and look back on it and what we were talking about. Let me send this to you guys, everyone. Even if you don't have a Financial Times subscription, just post it. You'll have the article as a reference and the headline as a reference. So you guys can screenshot this, whatever, and at least take notes on this little screenshots. Let's do it on the daily or 4 hour, whatever you guys think. And at least take a picture of this right here, this little leg down, or however you see it best, and put that as a reference and take notes and say, okay, well, there was some optimism surrounding the trade talks. There was put this in there, put this little article that Anthony sent, take notes of that, and you guys will start to see, you guys can look back on this and see how we ended up playing out. Because this could be a possible scenario that the market could start pricing in a third rate cut for the slightest bad news that we see with the China and US, with the trade war. Now, if we're looking at this from structure, where do we think we can maybe come down to? I do like this 5 level, this 5.0. I do think that would be a pretty decent level. Now, guys, we don't want to get, there's a time when we don't want to be so short, but that's where we're looking at structure. And I think this is a substantial level that we could possibly turn around at. Now, if we're looking at this on the monthly, this isn't this is a large move on the daily kind of 4 hour, but looking at this on a monthly perspective, let's just kind of see what these moves are looking like to see, okay, well, is this really that big of a move? Now we're seeing the market's usually really giving us kind of more of that. I mean, we're going back kind of afar, there's different stuff happening, but as of lately, I think we could at least push to that level. Now, if we start to, this is where I would like to see a potential to where maybe we could make more of a substantial, I guess, bottom, and that I want to be a little more cautious about how much sediment that we have pushing into these lows. Because that is where we get susceptible to or vulnerable to short squeezes, to where people get so short in the market that there's almost people get out of their position so fast that you see a big short squeeze and boom, you get a pretty fast retracement to where and then also the sediment can definitely shift after that. But I think there's a little bit more downside before we start to push into those lows. Now, as somebody was actually asking me a while back, or just recently, it was New Zealand dollar net shorts, net speculative positions, investing. Just a quick, it should pop up right here. And we don't need to go too far into this. It's a lot. It's not complex, but it's a little bit more. We don't need to overwhelm with. So let's see if it loads. So CFTC, NZD. So this is looking at the NZD from the futures. So it's more based on the NZD USD because that's what those futures are. They're in with the USD. Now we can see that we are getting kind of, look again. This is the same stuff, guys, that we play: mean divergence, regression to a mean. It's the same, like I said, the same thing in everyday life. I'm sure you did something today or maybe this week that you've seen kind of came back that wasn't as much as you expected, or you watched the football game, whatever team you liked didn't score as much. It's the same stuff here in the markets. Obviously, there always is some sort of regression back to a mean. Now, the hard time is, okay, well, we can see that now. Boom, okay, cool. It came back to an average or whatever, but we are starting to get to where we are at substantial levels that we haven't seen. Let's just scroll all the way back. Like, look at this. That we haven't seen since 2009 and probably even more. Now, this is how net short the market is on NZD. And this is where these short squeezes can happen, to where people get so net short, there's no one left to sell, or there's no one left to buy from these people that are selling, and you get a pretty aggressive turnaround. So we need to be kind of cautious on that. But I think that I would like to see this kind of come down to this 5 level first. Well, let's take a look at that NZD quick. Let's just take a quick look, kind of see what we're looking at too for structure. Same thing. I mean, I would like to see us come a little bit lower, but I'm going to be more cautious at these lows. I think just from that structure, I would like to see, or I think that we could come down a little bit more. This is just something to keep in mind. Now, we don't need to be getting open interest and stuff, and because it's not, I think it's not relevant. But again, we just need to focus on the strategy and that. But just kind of slowly working this into you guys. You guys can take a look at it, but try. Don't let this deviate you from the actual strategy, guys. We need to still kind of be with that. So I would like to see a little bit more weakness in this NZD, and we'll take a look here at AUD quick. So guys, make sure you did screenshot at least this leg down and kind of see. Let's see what we get. Mark up what I told you guys to look at. The Financial Times article. Let's take a quick look at the data. So they're always going to be referencing back to the data. They're going to be the monetary policy, the MPCs, anyone on the central bank, Adrian Orr, Jerome Powell, blah, blah, blah. Inflation rate, we'll just kind of open that. Unemployment, it's kind of the same stuff. GDP, let's see, some manufacturing. Let's just look at consumer, we'll do retail sales. So we'll open retail sales. So it's a quick glance. Inflation is kind of, it is below the 2% target that New Zealand has. And I think they might even be between 2 and 3%. So we can just quick look, I'll show you guys. Inflation target, we'll get something quick. A little bit faster so we can see, let's see. Kind of steer here. Well, let's see. It should say, if you were to do a little more research on here, it would say that they're looking at, again, that same 2% target, but they might even say 2 to 3% is what I think the central bank or the RBNZ says for their inflation. So that we still are a little bit below we're below the 2% target. Now I think that could maybe give them a little bit room to cut some rates, maybe a little bit more. Let's see when the next reading is coming out. So about 2 weeks. So this match consensus up a little. So this is definitely gonna be important. That's gonna be very important to look at. Unemployment rate at some pretty extreme lows that we haven't seen. Pretty crazy. GDP, again, hit off on some almost 3-year lows. Let's look at the 5-year chart, 10. Last time we seen that level was around the beginning of 2014 was the last time that we saw this 2.1%. And when did this thing really start to decline? Back in 2015, 2016, but we did get that, again, another push around here from the trade stuff, in my opinion, that did push us to these lows. So you are seeing the GDP kind of come into some lows, and I think this, you guys know the game. If we start to see the trade stuff come back in, you know that the data that we have at hand is, I'm not saying it's not, well, it might be kind of terrible, but we've been seeing this thing on the decline. Now, I'm thinking that this could give us a little bit more room to price in another cut, and for the RBNZ, if things are being data dependent, that if they do see the trade war escalate, that pressing catalyst, they're going to want to possibly start doing a third cut, or like they said, going to some unconventional measures with monetary policy. As the country faces sluggish growth conditions amid trade tensions and global economic slowdown. So those are the two pressing catalysts. Data published by NZD, statistics showed the economy grew by 2.1%. We just looked at that. A seasonally adjusted basis. So we don't need to go through the whole thing. Added, is likely to cut to 7.75%. early next year. So so again, guys, there is a possibility that we could see this get priced in, another cut get priced into the market. Now we are at some structure. Hopefully you guys did screenshot this, mark it up, because you can look back and we can see, and we can almost get in on this to see and start almost pricing it in ourselves. I mean, if we think that this trade stuff could continue to go on, some of this economic slowdown, so you need to be looking at other economies that are what we're classifying as like global slowdown, some of these bigger economies, Europe, kind of how's the US doing? And of course, China, looking at what China is doing. So let's just take a quick look at what we got for this calendar this week, or on the calendar. Let's see. Let's see if there's anything tonight. We'll do 29. Right here. So, pretty important right here, guys. Not that it's not because I saw this, but because it's manufacturing in China. We have the cake center, however you say that, manufacturing there. So we start to see, let's see kind of what we're looking at. Business confidence already kind of a little bit lower. Private sector credit, I'm not really too worried about that. So let's kind of see what we're looking like. 5-year. So you guys, we're gonna need to watch this, kind of see how this comes out. And remember that China did announce their stimulus, or wanting to do stimulus. We'll take a look at that here shortly. Now, NBS manufacturing PMI looks to be on the decline still as well. We did get a little bit better readings. 49.5 here. We did come out a little bit lower than consensus. Now today, we're going to see what we come in at. There is a possibility. We could get a good, decent reading. That's a possibility. We could get a bad one. But if this thing continues to decline, that we're going to see more investors, more traders start to actually price some more NZD weakness into the market. So that is what I'll be watching for the week ahead. GBP looking for that weakness. JPY, I would like to see a little bit more of a catalyst, or the catalyst at hand to give us a little extra boost. Same thing with that CHF, but it's still kind of looking like already that we could see the breakout, retest this zone, retest the initial breakout, then we could see this thing push up to that level we're looking at, that 50% level on the index. Looking at CHF quick, kind of at some structure here. Let's see kind of what we get there. Boom, boom. At this consolidation. So, I'm going to want to watch the CHF again around this level right here. And, if we start to consolidate pretty tight up in here at this 265, I might anticipate that we're going to continue to move to the upside. Move to, let's see what we're looking at. Let's see, 38.2. That we can at least get up to that 50. That would be something that we're looking at. So that's my bias for this week on these currencies. The main thing, guys, is just going to be that GBP, JPY. Let's see kind of what else, some other currencies that we're looking at. If we're looking for some NZD, maybe NZD weakness, JPY strength. I don't see any setups here that we can maybe play. Again, guys, that's the thing. We're sitting on our hands. We're being patient. We're trying to be opportunists. We're not, cool. You can call yourself a trader. Yeah, we're trading. But we want to look for opportunities, guys. Opportunities. USD JPY. CAD JPY. CAD CHF. Let's see Euro JPY. Let's actually take a look at that dollar index quick. So yep, I'm going to want to see this push more up into these highs that we have. Just this high right here. And once we get to there, if we get to there, then we'll see what we could possibly happen. Now, I'm not really asking for a break of the high, but as we've been looking at and as we've been anticipating that, I don't hate this thing to come up a little bit deeper, but we're just going to go with the most recent high, price discovery. And we've seen this thing already trade back up there. Now, I don't think we're asking too much to trade back into this high. Kind of came back, retested structure from market structure standpoint. But if we're still seeing funding issues from that the repo market, so we'll just jump over that quick since this is recorded. I know some of the guys can see that. So let's see if we can find something. Repo market. So what this repurchase or repurchase agreements, that's what they're called, is when we have an institution or firm or whoever needs some capital. They may have some sort of assets. So I used this example last time. Let's assume I'm a bank and you all, let's see how many, 19 of you or all 15 of you on the webinar are another institution. Now let's say I needed to have some, needed to meet my reserve requirements demanded by the Federal Reserve. I need to have so much, I guess you could say equity or reserves on hand that I may need to borrow capital from some other institution. Now, if I have some sort of asset, what you guys could do is buy that from me. So when you guys are buying it, you guys are giving me some capital. Now the agreement is, it's called the reverse repurchase, is the opposite, it's the vice versa, it's the opposite thing, is that I'm gonna be buying that asset that was initially mine back from you, but guys, I'm going to be buying it back at a higher price, a higher interest rate. So that's the basics of what a repo is. Now, a lot of what we're seeing is that dollar funding. So we're seeing people hoarding dollars in the short-term interest rate market. We're seeing, it's a whole other, financial market out there that we're seeing that a lot of institutions are, this is more of an institutional level that is going on, bank level. But what it's showing is that, dollar funding is getting hard, that repo rates are going up because, if there's more risk involved, if things are harder to get, you're going to see more, you're going to see a higher interest rate, you're going to see more, it's harder to get. So you're going to see that banks are charging more or higher interest to, if you want our dollars, you have to pay a little bit more. If you need your reserves, you're going to have to pay a little bit more. So if you're seeing a scarcity of dollars, that's kind of what also we're seeing, and that if that does maybe persist, and maybe it does have a little bit of a lagging effect, that we can maybe see this still carry over into some dollar strength. And not only that, that if we do have the trade stuff pick up, if we do have, there's still some risk off in the market, that we could have some investors buying U.S. government bonds, that typical safe haven, into the markets. So that is a plausible, realistic bias that we're looking at for this week, and that I'm going to be looking at. So I would like to see that, and I think the market still is a little bit more optimistic that there may not be cuts right away, but I'm not ruling them out. Trump will most likely get his way in the future. He will push for it. And if again, like I say, if you love him or hate him, whether he gets another 4 years or not, it's going to add a lot of volatility. And if he's you pretty much said he has another 4 years to at least push for a weaker dollar. So we can't, my bias is that if he does get elected, he's going to get his way. He's going to push for that weaker dollar. He's, if he even starts to see this equity market, tumble, go to, I don't want to say maybe record lows, or just start to, even if he starts to get a little fearful, that you're going to see him push even more. So we can almost get into his mindset and assuming that, okay, well, he might be getting fearful that this market's going to tank. People are going to blame it on him, blah, blah, blah. So he's probably going to try to push for this dollar. So if we start to see him talk about that more, we can almost assume, you know, he might be getting a little bit fearful about this equity market, or he wants to at least keep it propped up. We already see that right now going on with him talking and bashing the Federal Reserve, you know, saying that they're, you know, whatever he's saying to them, that they're not doing their job, that they're dumb, or I don't know what else he said, but that's it. So there's a lot of psychology in this, guys. There's a lot of psychology. It's a lot of it's psychology. It's crazy. And that's why we need to be forward looking, understand his mindset, understand in, you know, why is he saying this? What's his you know, goal by saying this? What's his goal by trying to talk about Jerome Powell like that, or the Federal Reserve? So at least like to see us up to the highs, maybe this week. That's a possibility. So we'll keep an eye on that. Now we're already getting a little bit of a boost. So yeah, guys, let's watch that. Please, guys, I hope you guys did screenshot this. I'm gonna leave it up for a little bit, or just go to your index and just screenshot this leg down. Mark up what we were looking at in here for the central banks, that article, and then you guys, let's say it did play off down here, or play out, and we did get to these lows. You guys you'll see this play out. It's going to give you guys more confidence, saying that, okay, well, we were looking at this on the webinar. Here's the data that we were looking at. Here's what we were trying to be forward thinking with. Now it did play out. You guys can go back and see. Let's say it did right there. Boom, we get that sell off. And we're down here. You guys are looking at it. Let's say October 3rd. Let's just say, okay, October 8th. Let's say October 8th. We get down here, whatever. You guys can go back and you guys can look back at September 27th and, you know, understand why this happened. And you guys can relate it back to, okay, well, I was looking at this up here. This is why Kyler told me this, or we were looking at this on the webinar, blah, blah, blah. And then it's like I said, it's gonna give you guys more confidence. It's gonna help you guys understand why this is happening. And it's gonna help you guys be more forward thinking in this, and just understand the psychology and seeing this stuff priced in. So please, please, please screenshot this, all 15 of you. I need you guys to screenshot this, mark that up. If you have any questions, guys, shoot them over, please. So let's just take another quick look at the calendar, see what we kind of got. So China, GDP, importance, Germany, Japan, more Germany, some manufacturing. Right here on Tuesday is important, guys. Governor Lowe, you need to see what he says. Manufacturing, this is a pretty packed week. Pretty packed week. Balance of trade, okay, cool. A lot of ECB members talking, Fed Evans, Fed Quarles, however you say that. Finding some non-manufacturing. Friday's gonna be NFP. So guys, this is gonna be a pretty busy week in the markets. Now, again, same thing, guys. All these pressing catalysts are still in the market. China, trade war, Brexit, Iran, Saudis. Let's see, as Sam said, I got a friend Sam in the academy. Let's see if it was another article. So we can't, guys, I know so much stuff is happening that we can't, try not to forget, and like, this is not done. Whenever the Yemen, Houthi or Houthi, whatever, the rebels attacked Saudi, the oil base, guys, that's not done yet. I mean, they just bombed the hell out of this oil thing, and it seems like things are still maybe picking up. Now, again, guys, we got to remember, this is the media. Things may not be as bad. They could have just lit this thing on fire. Who knows? They're crazy. But we at least need to kind of acknowledge that, okay, well, this could possibly escalate, and we need to just stay on top of that. So there's three, let's say there's about 5 things I need for you guys to pay attention this week. Trade war, as I mentioned. Brexit, what's going on with Brexit? What is Bojo doing? Rebels, Saudi, Iran. That's the third. Fourth is going to be monetary policy. It's going to be, that could include what Lowe is saying. It's going to be seeing what some of these Federal Reserve chairmen are saying. The fifth is, I wish I had a fifth. Maybe we just maybe put China data in there. I mean, that could be that. Fifth, make up. But there's about 4 or 5 things that you guys need to watch for the week. 2 or 3 of those are those same pressing catalysts. So that's what we will watch. Same stuff. We're sticking to the strategy. Same pressing catalyst, guys. Nothing to be overwhelmed about. Remember, I need you guys to hear me screaming in your head. Pressing catalyst, then the economy, everything included in that, and then monetary policy. So if we start to see data come out, bad data, we can reflect back and say that's most likely because of these pressing catalysts: global slowdown, China, blah blah blah, and then we can get that bias to be forward thinking. What could possibly happen in the markets? How's the markets going to react? So that's it, guys. Please let me see what questions you guys got. If not, you guys have Slack. Do not hesitate to reach out. Shares. GBP, JPY, guys, is the only thing I'm going to be watching. No reason I don't think we can't get down to 131. Now let's see, guys. Let's see what, if we were getting it right here, stops right above the highs. 2% on here. This is a possible 4% trade. Now, if you did scale in, I think it'd be 5%, upwards of 6 on one position. This is the possibility with this. Now, I'm not, don't think I'm trying to say we're going to make millions on this trade, but it's okay to be a little bit more aggressive, guys, once you are comfortable with the fundamentals, once you are understanding, and once you guys understand the edge right here, the edge that we're exploiting, the strategy itself, it's going to be the same thing over. It's like, imagine you guys are doing the same play, the same football play every time. You're doing, I don't know, Hail Marys, you're, I don't know, running, and you're a running back, and you're running the same, you run the same hole. Now, you do that every game, you're going to get tackled, but it's a little bit different here. So it's just, you're getting used to it. You're getting used to it. You're learning the nuances of it, guys. That's why, we can't, do not be switching up the strategy, guys. You think it doesn't work. Guys, this is a strategy backed by a market methodology. This is not some crazy moving averages. This is not some crazy BS like that, guys. It's mean divergence. This is a very common strategy, but with any strategy, guys, we need to understand the nuances of it. We need to understand it as a whole. And when we think about this from a business perspective, no matter if you're in real estate, Apple, who knows, any business, guys, they aren't switching up their strategy all the time, because they cannot build a business when you're changing strategies all the time. How do you build a business when you have 1 week you're doing this, then 1 week you want to do that? And you need to do this thing, stick with it, learn the nuances of it, and then you can start understanding, okay, maybe, so on. So again, guys, this is a business. This is not a game. That's just how we look at it. Strategy, our system that we're executing on. There's a lot of opportunities with this strategy, guys, a lot of opportunities. And I absolutely love the strategy. I have 100% confidence in it. Cleveland has 100% confidence in it. That's all we do. Now, there's a little more stuff that we do aggressive to get in a little bit more that we can scale into it and get higher risk rewards. But for now on, guys, just focus on this 23.6. Just focus on learning it, the conditions, those 4 conditions, and the rules. So that's it, guys. I'm glad I did get this recorded. I thought it was a good webinar. So we'll do